The second type of exchange rate system that you need to be aware of is the fixed exchange rate system. This is sometimes called a pegged exchange rate, and the definition of this is an exchange rate system where the currency's value is fixed against the value of another currency, another basket of currencies, or to another measure of value such as gold. What you need to be able to do if you want to have a fixed exchange rate is you need to have a central bank with reserves. What I want you to think about in terms of reserves is you can think that reserves are just a stack of cash that the Bank of England keeps in its vaults to use to manage its fixed exchange rate. And you can think that they've just got stacks of dollars, stacks of euros, stacks of RMB, even stacks of gold they would just have in there in order to be able to buy and sell to manage what's happening with the pound. So the way that it works is this. You'd have the same supply and demand diagram for the currency. I've changed it slightly to say that now the pound is in terms of Deutschmarks. And you might have a maximum price and a minimum price that you're willing to have in terms of the fixed exchange rate for this currency. So what that means is if people start selling their pounds and it's going below the minimum, the Bank of England has to intervene. So the Bank of England would have to intervene and say, right, we're going to take our reserves and we're going to buy our pounds back off the market. By them getting into the market, getting involved and buying pounds, that's going to shift the demand curve for pounds right again because the Bank of England is buying pounds sterling, and this is going to stabilize the exchange rate at their agreed fixed level, and certainly within those two bands. This is a really important graph, this one here, to be able to show and explain how the central bank is managing the currency in a fixed exchange rate system through its reserves. So the advantage of the fixed exchange rates is that you have reduced risk in international trade because you know exactly what the exchange rate is going to be. You know exactly how much your products are going to cost if you're importing them. It also means that you've got discipline that's imposed on firms. Firms have to make sure that their costs stay down because they know that the exchange rate is not going to be able to fix it if they want to sell abroad. The disadvantages of the system, though, is that the high level of reserves that you need to hold on to be able to manage the exchange rate is quite expensive, and there's an opportunity cost of having all that money set in the central bank just so you can buy your currency. There also means that there's loss over domestic monetary policy, which we'll talk about later. There's no automatic rebalance of payments, which I think you'll want to look up, and also the possible attacks from currency speculators, which we'll see in the explanation about Black Wednesday and what happened there. Now, when we talk about fixed exchange rates, sometimes people refer to this idea of the impossible trinity. It's a triangle where you've got free capital flow, sovereign monetary policy, and a fixed exchange rate, and you can choose any two, but you can't have all three. And to make this clear, think that if you've got sovereign monetary policy, that means you can set your own interest rate. If you have free capital flow, it means that investors can move money across your borders without restriction. And like we said, a fixed exchange rate means that your exchange rates don't change. You manage them actively to make sure that they're going to be within certain levels. So think for a minute, if the interest rates rise, what's going to happen? Well, like we said before, if you have interest rates rise, then hot money is going to flow from the country with a low interest rate into the country with a high interest rate to take advantage of the better return, just like we said before. This, in turn, is going to increase demand for the currency, which makes the exchange rate appreciate. We saw this earlier in this lesson. But if the exchange rate appreciates, this means that we're not going to have the fixed exchange rates that we wanted to have before. So that's why you have to pick two, and you can't have the one. And you can do a similar thought experiment involving all of those three to show why you can only have the two of them and not all three. Now, a really good example of why this all comes together is Black Wednesday. This was from the early 1990s when the pound sterling was fixed to the German Deutschmark, because the UK was part of what was known as the European Exchange Rate Mechanism, or ERM, which fixed all European currencies to the Deutschmark. Now, there was something different happening in each country. The Germans were fighting inflation, so they wanted to have higher interest rates, but the UK was recovering from a recession, so they wanted low interest rates. And so, because of the different needs, there was pressure on the pound to be able to maintain this 2 Deutschmark 0.77 floor. Basically, the pound wanted to go below that that minimum price in Deutschmarks. And the other problem was currency speculators were selling billions and billions of pounds on forex markets, thinking that they would make profit if the pound ever devalued. And so by them selling, it was continuing to push that supply curve to the right. In an attempt to keep the pound above the price floor, the Bank of England did two things. Number one, they raised the interest rates in order to get people to buy pounds again, like we said, and they also bought pounds using their reserve currency in the Bank of England. Eventually, they couldn't keep up with these things. The country and the economy couldn't handle higher interest rates, which went up to eventually 15% from 10%, and the bank also ran out of reserves. And so on Wednesday, the 16th of September 1992, the then Chancellor of the Exchequer, Norman Lamont, announced that the pound would no longer fix its exchange rate to the Deutschmark, and the UK left the ERM. The pound has been floating freely ever since. All other currencies in the ERM eventually joined the euro, and this shows how the UK picked, and they said that we want to have freedom in domestic policy and free-flowing capital, and we're going to have those two things instead of having the fixed exchange rate. And in fact, if you look back through and you go to the fixed exchange rate graph, this is exactly what happened basically, is that they said, we want it to be 295, 277 at the very minimum, but a bunch of people started speculating, selling the currency, thinking, right, these pounds are going to be cheap eventually. That was a price that they were going for. So the Bank of England kept trying to keep up the price by selling its reserves and promising higher interest rates, but eventually they found that was not sustainable, so they settled for the 266, which is eventually what it depreciated and devalued to.